Over the long term, property provides reliable, inflation-beating absolute returns. It behaves very differently from erratic bond and equity markets, making it an excellent portfolio diversifier. But real estate is defined by its physical constraints. Every building has a unique location and structure. The supply of land is physically finite. And because there is no centralized exchange, a property's valuation remains entirely subjective, right up until the moment a sale closes. The financial profile also changes depending on the structure. Residential property relies heavily on short leases and capital growth over time. Commercial property, however, is driven by long-term contracts spanning 10 years or more, providing a highly reliable stream of income. So while property can generate exceptionally steady returns over a decade or longer, its massive physical weight and immobility create a severe financial constraint: illiquidity. You can only buy and sell property in discrete, massive units. If you need cash on a Tuesday afternoon, you cannot simply liquidate 10% of your warehouse. To transfer ownership in the secondary market, you have to navigate complex legal hurdles, thorough property inspections, and high transaction costs. Because of this extreme friction, combined with the millions of dollars required just to enter the market, holding a truly diversified portfolio of direct commercial real estate is largely restricted to massive institutional players like pension funds. For retail investors, choosing to buy property directly means accepting total control of the asset and surrendering almost all of your liquidity to get it. The market recognized this high capital barrier and engineered a workaround: the property mutual fund. By pooling retail money together, these funds can buy and manage massive commercial assets. Looking at this document, we see the risk spectrum. At the baseline, core funds benchmark against property indices. To chase higher returns, managers offer Core Plus and value-added funds. As shown, these take significantly more risk, using gearing, borrowing to invest, pushing leverage between 60 and 75%. This diagram shows a fatal flaw: the liquidity mismatch. Investor capital flows in fluidly, expecting quick redemption, but physical buildings take months to sell. During the 2008 crisis, plummeting values triggered a rush of withdrawals. To prevent fire sales, funds imposed moratoria, completely freezing withdrawals. This exact cycle repeated during the COVID-19 pandemic. Lockdowns made it impossible for surveyors to conduct reliable property valuations, forcing funds to freeze their doors once again. The open-ended property fund attempts a dangerous illusion. It tries to treat rigid, slow-moving concrete as if it were instantly accessible cash. To permanently solve this liquidity trap, the market developed a closed-ended alternative: the Real Estate Investment Trust, or REIT. A REIT acts as a corporate wrapper around the real estate. Because shares are traded daily on a stock exchange, investors can buy and sell their stake instantly, without ever needing to sell the underlying building. Normally, holding property inside a standard corporate structure creates a problem of double taxation. The corporation pays tax on its profits, and then the investor pays income tax again on the dividends they receive. A REIT bypasses this completely. Meeting specific qualifying conditions, the REIT pays zero corporate tax on the income and gains from its property portfolio. This flowchart explains the primary condition. A REIT is legally required to distribute at least 90% of its rental profits directly to shareholders as dividends. This structure shifts the tax liability entirely away from the corporation and onto the investor. By wrapping physical buildings in publicly traded shares, REITs transform concrete into a highly liquid, tax-advantaged asset, making them a primary tool for income-seeking investors. Financial engineering has successfully turned rigid land into tradable paper. But when you invest in property, you must actively choose your preferred balance of control, liquidity, and systemic risk. Direct property gives you maximum control and true, uncorrelated diversification, but it requires massive upfront capital and offers absolutely no daily liquidity. Property mutual funds solve the capital barrier by pooling money, but they expose you to systemic mismatch risks. This flaw is so severe that regulators have begun introducing long-term asset funds, which require a strict 180-day notice period before you can withdraw your money. This radar chart compares our three options. REITs maximize your liquidity through the stock market and mandate high dividend payouts. However, because they are traded like stocks, their prices are dictated by market sentiment. They frequently trade at premiums or steep discounts to the actual net asset value of the buildings they own. Property remains an essential tool to stabilize a portfolio against inflation. But before you deploy capital, you have to decide whether you are buying the physical concrete itself or the volatile financial plumbing built around it.